has been a bumpy ride for markets. Daily swings of more than 1% now the norm. I asked investing legend Bill Gross the question on many investors' minds in terms of investing with negative yields. Take a listen. Do you think the U.S. economy enters recession this year?
I think perhaps next year.
Joining us right now, Bank of America Deputy Chief Economist Meyer. Michelle, good to see you. Thanks so much for joining us. And you say there's a 50-50 chance that we head into recession this year.
No, well, we would say it's a 25% chance that we'll head into recession in the next 12 months, but there's just under even odds that the Fed would have to either abort the hiking cycle or reverse course. So we do think that there is the potential for a policy response that could avoid an outright recession if we were indeed slipping in that respect.
What could they possibly do? I mean, this is the conversation we're having every morning, that the Fed is sort of out of bullets.
It's true that their bullets are more limited now that they've done a lot already, but we don't think they're out of bullets. I mean, the first step is that they can just go from a hiking bias to an easing bias, and they can do a lot through their communication, or at least attempt to do a lot through their communication. Lower the dots, use forward guidance, sound supportive. They can reverse their rate hike. They can do another reinvestment program where they twist, so they change the duration of their portfolio. They can do another round of QE. They could go negative, although I think that they would like to avoid that. So it's true that at this point in the cycle they don't have as much in terms of their ammunition, but I don't think they're out entirely.
And Jack Adder, your cover story is about this.
Yeah, Barron's, I think we would agree. We're not saying, we think the probability is we will not go into a recession, and that we see on balance the data suggests we could enter a mildly virtuous circle where more people are getting jobs, salaries go up just a little bit. That leads to more household formation. It leads to a little bit more in CapEx spending, and we could get to maybe a 3% growth rate by the end of the year, which by historical standards is not so great for recovery. By current standards is fantastic in this global situation. Better
than where we are now.
Yeah, exactly.
You know, I'm going to make the argument that's a little aggressive. Look, I'm not looking for a recession as my consensus view. I'm somewhere near Michelle in terms of the odds. Michelle, I did want to ask, you know, the Fed going to an easing bias, as you put it. I think there's a lot of thought out there now that whole game is over. That going to an easing bias might send the wrong message, that things are bad, and it could spook markets, it could spook business owners from increasing that CapEx that Gene and that's going to talk about tomorrow, apparently in the paper. How does the Fed manage that?
Yeah, so that's a really good point. I think it's something that a lot of clients are concerned about, which is, look, if they come out at the next meeting or in June and they talk about the significant downside risks and they talk about moving to an easing bias, it looks like they have lost their credibility, and it also appears as though they're that much more concerned about the outlook. So I think that they do have to be extremely careful in terms of how they communicate it. But it is possible in the sense that if you have enough deterioration in the markets, if you start to see the real economy actually weaken, if the Fed were to come out at that point, once the negative news is already known in the economy and the markets, then perhaps they have the ability to provide some support. But they have to time it very, very well.
What about this election season, though? Because it is unorthodox in every way, and I hear more and I read more that certainly what you're hearing on the campaign trail, all the candidates talking down the economy, even the Democrats, and the two front runners, Bernie Sanders and Donald Trump, have wackadoodle ideas in some ways about how to deal with it, whether it's a 45% tariff on imported goods from China, whether it is single-payer health care for everybody, and tax rates that go back to the Eisenhower years. I mean, how much are clients talking about that at this point?
Is that fear and uncertainty impacting things?
I think it's definitely a conversation in the markets right now. A lot of people are clearly interested and they're concerned on either side. But I think it's very unclear as to what the policies actually are that the candidates are arguing. So at this point, it's hard to have a clear view of how to trade it or what the implication is for the markets. But I mean, I think the cover bearings last week was just that, right?
Trump and Bernie, exactly. And I think that while I agree completely that nobody knows what the policies would be, that fact is scary. You get a Hillary Clinton or a Jeb Bush in there, we know exactly what they would do for the most part. And, you know, I don't think there'll be any big surprises. The market knows it. That's probably built into current prices. But a Bernie or a Trump, you just don't know, and that's scary.
Right. Make me put cash to work if I don't know what the economic policy is going to be in
that's what the negative interest rates are all about, right? Get your money out of the bank and put it to work. I mean, that's, I don't know.
Yeah, exactly.
Earnings down 4% year over year. You worried?
Yeah, I mean, I think, there's a lot of signals throughout the market. Earnings, credit spreads widening. There's a number of things to be concerned about in terms of what the markets are sending or even what companies are reporting. So that's why we have an elevated recession risk, and that's why we've taken down our forecast for growth. We're only looking for low 2% growth. But despite that, I think if you take a step back and you look at the macro variables, we're still seeing quite robust job creation. Consumer spending looks like it's improving. Confidence has held up in the household sector. So yes, I think you are in an environment where the corporate sector is weakening. We're seeing that through a variety of indicators, but the household sector still seems to be pretty robust.
All right, counting on that consumer.
Yep.
Michelle, good to see you.
Great to be here.
Thanks so much, Michelle Meyer.